there, and welcome to the Property Wealth Podcast. Today, we've got an interesting topic that's been on the minds of many investors, especially those looking to diversify their portfolios. We're diving into Section 8 rentals, what they are, their pros and cons, and how to set them up effectively.
Yeah, Section 8 can be a great option for investors, but it's important to really understand both sides. There are some fantastic benefits, but also some challenges you might face along the way.
Exactly. And for anyone over 40 who's looking to build long-term wealth through real estate, this episode is definitely for you. We'll cover everything from how to qualify as a landlord to what to expect in terms of rental income.
And let's not forget about the tenant side of things, too. Understanding who you might be renting to and what support systems are in place can really help set you up for success.
Right. So whether you're just starting out or you've been in the game for a while, we'll break down the essentials. Plus, we'll share some tips to navigate the setup process smoothly.
Yeah, and it's really about making informed decisions, isn't it? So let's jump right in and start exploring how Section 8 rentals work. So, Sarah, when we think about Section 8 rentals, especially for folks over 40, it really hits home in a few key areas. I mean, retirement timelines are shifting, and people are starting to realize they need a solid plan to make their money last.
Absolutely, Mike. With the cost of living rising, inflation seems to be a constant worry, right? I mean, people are looking for ways to ensure their investments can keep up.
Exactly. And that's where Section 8 can be quite appealing. The government backs those rental payments, which provides a level of stability that's hard to find elsewhere. I had a client, let's call him Tom, who was nearing retirement age. He was nervous about his savings dwindling, and he wanted something reliable.
Right, that must have been a tough spot for him. What did he do?
Well, Tom decided to invest in a Section 8 property. He was really drawn to the guaranteed income each month. It was a game changer for him. He felt a lot more secure knowing that even if the market fluctuated, his rental income would remain consistent.
That's a great point. The peace of mind that comes with that guaranteed income must be huge, especially as people are thinking about how to stretch their retirement savings.
For sure. And, there's also the emotional side of financial security. Many investors in their 40s and beyond are thinking about their families, wanting to create a legacy. They want to ensure that their kids or grandkids are taken care of.
Definitely. I hear that a lot. People want to pass down wealth, not just assets. Investing in something like a Section 8 rental can provide a steady stream of income that can be inherited.
Exactly, and it allows for a smoother transition of wealth. I had another investor, let's call her Linda. She was in her late 40s, and she started investing in Section 8 properties because she wanted to create a nest egg for her children. She appreciated that the rental income could help fund their education.
That's so smart, and it's such a practical way to think about family support. It sounds like she found a way to combine her financial goals with her family goals.
Right, and she also mentioned feeling less stressed about her financial future. It was like a weight off her shoulders. She knew her children would have a safety net, and she wouldn't be relying solely on her retirement funds to support them.
That emotional aspect is so powerful. It's not just about the numbers. It's about how people feel secure and confident about their finances.
Exactly. And with the current economic trends, like rising inflation and market fluctuations, having a reliable source of income is more critical than ever. It's like a buffer against the unknowns.
And I think a lot of people over 40 are realizing they need to be proactive about their investments. Waiting until retirement to figure it out can be risky.
You're spot on. And it's not just about the security of the present. It's also about planning for potential market shifts. Section 8 properties can be a safeguard against those unpredictable changes.
So true. Plus, in many areas, there's a high demand for affordable housing. That means investors can often find good opportunities within the Section 8 framework.
Yes, and that demand can lead to more stable property values. Even during economic downturns, people need places to live, and Section 8 is a crucial part of that equation.
It's like being part of a solution while also building wealth. I think that's a perspective that really resonates with many listeners.
Absolutely. And let's not forget the tax advantages that can come with owning rental properties. For those over 40, tapping into these benefits can really enhance their overall financial strategy.
Oh, definitely. Tax deductions on mortgage interest, property depreciation, and repairs can all help reduce taxable income. It's a win-win.
Right. And think about how those savings can compound over time. For someone like Linda or Tom, those deductions can significantly boost their cash flow.
And that cash flow can then be reinvested or used to pay down other debts, which is especially important as people approach retirement.
Yes, and it's also about creating a diversified portfolio. With the way the market has been, relying solely on one type of investment can be risky. Section 8 rentals can be a solid piece of that puzzle.
And I think that diversification can help people feel more confident in their financial future. It's like building a safety net.
Exactly, and let's not forget about the community impact. Investing in Section 8 can help provide stable housing for families in need, which can lead to stronger neighborhoods.
That's a great point, Mike. It's not just about the investor. It's about the positive ripple effects on the community as well.
Right, and I think that's something that resonates with a lot of people over 40. They want to make a difference while also ensuring their financial future.
So it seems like Section 8 rentals really offer a lot of benefits, from financial security to community impact.
Definitely. And now that we've laid out why this strategy is so important for folks over 40, let's dive into some core strategies for setting up a successful Section 8 rental. So let's dive into some core strategies for Section 8 rentals. One of the first things I like to consider is the asterisk 1% rule 9 times. It's a simple way to evaluate if a property is worth your time.
Right. The 1% rule. That means you want to aim for your monthly rent to be at least 1% of the purchase price, correct?
Exactly. So if you buy a property for $100,000, you'd ideally want to rent it for at least $1,000 a month. It's a quick way to gauge if the cash flow will be strong enough to justify the investment.
Makes sense. And with Section 8, the rent is often guaranteed, right? That must make it easier to hit that 1% mark.
Definitely. The government backs those payments, which can be a huge relief. But it's important to remember that not all areas will support that rent level. You'll want to do some market research, look at comparable rents in the area to see if it aligns.
Right. So what about the asterisk 50% rule? I've heard that's another helpful guideline.
Yes. The 50% rule suggests that when calculating your expenses, you should expect about 50% of your gross rental income to go towards operating costs. So if you're getting that $1,000 a month, you would expect about $500 to cover things like property management, maintenance, and taxes.
Got it. So that leaves you with $500 for cash flow. And that's before any mortgage payments, right?
Exactly. After factoring in your mortgage, you can see if the deal really works for you. It's all about understanding your numbers and ensuring you're not just looking at the rent. You're looking at the total picture.
Speaking of that total picture, let's talk about asterisk Toshkabep rates. What should investors know about that?
The cap rate, or capitalization rate, is another crucial metric. It's calculated by taking the net operating income, NOI, of a property and dividing it by the purchase price. For example, if your property generates $12,000 a year in NOI and you bought it for $100,000, your cap rate would be 12%.
Wow, that's actually a pretty high cap rate. What does that tell you?
A higher cap rate often indicates a better return on investment, but it can also mean higher risks or potential issues with the property. So you want to find that sweet spot. Generally, anything above 8% is considered good, but it really depends on the market you're in.
Got it. So how do you really evaluate a deal then? Do you have a checklist for this?
Oh, absolutely. I always start with a checklist to ensure I'm not missing anything. First, I look at the location. Are there good schools, access to public transport, and employment opportunities?
Those are key factors.
Next, I check the property condition. Is it move-in ready, or will it need significant repairs? That can eat into your cash flow really quickly. Then, I consider the local rental market. What are similar properties renting for?
That sounds thorough.
And don't forget about the financing options. You can use conventional loans, of course, but also look into FHA loans if you're just starting out. They allow lower down payments, which can be a game changer for many investors.
Right. Lower down payments mean you can keep more cash in hand for other investments or repairs.
Exactly. And don't overlook the potential of working with a local lender who understands Section 8 properties. They might have insights or programs that can benefit you.
That's a good tip. So, what types of properties tend to do best with Section 8?
Single-family homes are popular, but duplexes and multifamily units can also be great options. They allow you to increase your rental income while still qualifying for Section 8. Just make sure the unit sizes comply with the program's requirements.
And how about the local market? Should investors be targeting specific areas?
Absolutely. Look for markets with a strong demand for affordable housing and low vacancy rates. Areas undergoing revitalization or those that are emerging neighborhoods can also provide good opportunities.
What about the inspections and requirements for Section 8? I imagine that can be a bit daunting.
It can be, but it's manageable. The property must meet specific health and safety standards, which means you'll need to make sure everything's in good shape before you rent it out. This can be kind of a hurdle, but once you're compliant, the benefits can outweigh the initial hassle.
So once you've navigated that setup, you're more or less in the clear, right?
Well, it's smooth sailing until you hit some common pitfalls.
Oh, I can only imagine. What are some of those pitfalls investors should watch out for?
One major pitfall is underestimating maintenance costs. With Section 8 tenants, you want to keep the property in great condition to ensure they stay and that you retain your rental income.
Totally. Keeping good relations with your tenants is key too, right?
Exactly. Communication can make a huge difference. Happy tenants are more likely to stay long-term, which means less turnover and more stable income.
It sounds like building that rapport is as much a part of the investment as the numbers themselves.
For sure, Sarah. It's all about creating a win-win situation for both you and your tenants. You know, Sarah, when we talk about Section 8 rentals, one of the most common pitfalls I see investors fall into is over-leveraging.
Oh, absolutely. It's tempting, right? You get excited about a potential property and think, I can take on more debt, but that can really backfire.
Exactly. I had a client once who bought a duplex thinking the rental income would cover the mortgage and then some, but they stretched themselves too thin. And when a big repair came up,
like a roof replacement or something?
Right! Exactly that. They didn't have the cash flow to handle it. It turned into a real nightmare. They ended up having to dip into savings, and it caused a lot of stress.
So how can someone avoid that? What should they look for?
Well, a good rule of thumb is to always have a buffer. You know, a reserve fund for unexpected costs. Aim for at least 3 to 6 months of expenses saved up. That way, if something does go wrong, you're not scrambling.
That makes sense. And speaking of scrambling, bad tenants can really complicate things too.
Oh, definitely. I've heard stories of landlords who didn't properly vet their tenants. One investor I know rented to someone without checking references or income verification.
Yikes! What happened?
They ended up with someone who couldn't pay rent consistently. They were always late, and eventually, they just stopped paying altogether. It took months to evict them, and during that time, the landlord was losing money hand over fist.
That's such a tough situation. So, what can investors do to avoid that?
Well, thorough tenant screening is key. Check credit scores, verify income, and always call previous landlords. If a tenant has a history of late payments or evictions, that's a huge red flag.
Definitely, and I think some investors get so eager to fill a vacancy that they overlook those signs.
Right. It's important to remember that it's better to have a property sit empty for a month than to take on a tenant who could cause you headaches down the line.
Speaking of headaches, what about cash flow? That's another area where people slip up.
For sure. I've seen investors focus too much on the potential appreciation of a property and forget about cash flow. One guy the first worked with bought a property in a developing area, thinking it would appreciate quickly.
But the rent wasn't enough to cover the mortgage, right?
Exactly. When the market didn't move as quickly as he thought, he was left with a property that was costing him money each month. He ended up selling it at a loss.
Ouch! So what's the takeaway here?
Always analyze the cash flow before you buy. Look at the numbers carefully. Compare the projected rent with all your expenses, including mortgage, property taxes, insurance, and maintenance costs.
That's great advice. Now, something else that comes up is timing the market. A lot of people try to time their investments perfectly.
Yeah, that's a tricky one. I had a friend who waited for what he thought was the perfect moment to buy. but he ended up missing out on some really solid deals because he was too focused on timing.
And then the market changed, right?
Exactly. Prices went up, and suddenly he was priced out of some great opportunities. It's like the perfect moment never really comes.
So what do you recommend instead?
Instead of trying to time the market, focus on finding good deals that make sense for you financially. If a property meets your criteria and your numbers work, that's what matters.
That's such a practical way to look at it, and let's not forget about hidden costs. Those can really sneak up on new investors.
Oh, for sure. I had a client who was so focused on the purchase price that they overlooked things like property management fees, maintenance costs, and even utilities.
And those can add up quickly, right?
Absolutely. They were shocked when they realized their expenses were much higher than they anticipated. So it's crucial to account for all those costs up front.
And factor them into your cash flow calculations.
Exactly. You want a complete picture of what your investment will actually cost you. And if you don't, it can lead to some serious financial strain.
So if someone finds themselves in one of these situations, what can they do to recover or avoid these pitfalls in the future?
Well, first, take a step back and assess what went wrong. Learn from those mistakes. Sometimes it's just about making adjustments, like tightening your screening process or ensuring you have adequate reserves.
And maybe seeking advice from someone more experienced, too?
Definitely. Don't hesitate to lean on mentors or advisors who can offer insights. Real estate investing is a journey, and it's okay to ask for help along the way.
That's such a positive takeaway. This isn't just about avoiding mistakes. It's about building your knowledge and becoming a better investor over time.
Absolutely. Every investor faces challenges, but it's how you respond that defines your success in the long run.
Well, I think we've covered some really important points today. Let's transition to our next steps for listeners looking to dive into Section 8 rentals.
All right, so let's dive into some immediate actionable steps that listeners can take right now if they're interested in Section 8 rentals.
Yeah, absolutely. It's all about making that first move, right?
Exactly. First off, I'd say familiarize yourself with the Section 8 program. You can start by visiting your local housing authority's website. They usually have resources and information on how the program works in your area.
That's a great tip. And once you understand the basics, what's next?
Well, if you're looking for properties, tools like Zillow or Realtor.com can be really helpful. You can filter for properties that meet your criteria and even get an idea of the rental prices in your target area.
Right, and having a good grasp of local rental prices is key. It helps you know what to expect with your investment.
Exactly. And then there's the Bigger Pockets calculator. It's a fantastic tool for analyzing potential deals. You can input your numbers and see if a property meets your cash flow goals, which is crucial.
Oh, I love that one. You can also check out Deal Check for a similar purpose. It's user-friendly and helps you evaluate properties quickly.
For sure. And don't forget about Rentometer. It's a neat tool for comparing rental rates in your area. You just plug in the address and it gives you an overview of what similar properties are renting for.
That's super useful. And if someone is serious about diving in, having access to your local MLS can be a game changer.
Yeah, definitely. It gives you up-to-date listings and details on properties that might not be on other platforms.
So let's talk about habits. What small steps can someone start taking today?
I'd recommend starting with analyzing just one deal a week. It doesn't have to be a massive commitment. Just pick a property and run the numbers. It'll build your confidence over time.
Love that. And joining a local real estate meetup can also be beneficial. It's a great way to network, learn from others, and share experiences.
Absolutely. Connecting with like-minded people can really motivate you and provide valuable insights. You can find meetups on platforms like meetup.com or even Facebook groups.
And what about books? Are there any you recommend for getting started with Section 8 or real estate investing in general?
Oh, for sure. The book on rental property investing by Brandon Turner is a classic. It covers a lot of ground, including Section 8, and Real Estate Investing for Dummies is another good one, especially for beginners.
Those are solid choices. And podcasts. Are there any you think listeners should check out?
Yes, Bigger Pockets podcast is fantastic. It's filled with real-life stories from investors, including those who have experience with Section 8. You get to learn from their journeys.
That sounds inspiring. So to recap a bit, we've got useful tools, habits to establish, and resources to dive into.
Right. And remember, start where you are. Even if it feels small, every step counts, and the more you engage with the material, the more confident you'll become.
Exactly. It's all about progress, not perfection. So those are some practical first steps. Now let's bring this all together.
So as we wrap up our discussion on Section 8 rentals, let's highlight a few key takeaways.
Yeah, definitely. First off, the guaranteed income from the government can be a real game changer, right? It offers some stability in what can sometimes be a pretty unpredictable market.
Exactly. And then, of course, there's the potential for lower vacancy rates. With the demand for affordable housing, many landlords find their properties rented out pretty quickly.
Right. But we also talked about some challenges like the additional paperwork and the requirements for property maintenance. It's not just about collecting rent. There's a responsibility that comes with it.
Absolutely. And being aware of the local regulations is crucial too. Each area has its own set of rules that you need to follow, so doing your homework beforehand is key.
So true. But at the end of the day, if you're willing to put in the effort, Section 8 can be a fantastic way to build wealth through real estate.
Yeah, and remember, investing in property isn't just about immediate returns. It's a long-term strategy that can really pay off down the line.
So, if you found this episode helpful, don't forget to like, subscribe, and comment below with your biggest takeaway or maybe a question you have. And if you know someone over 40 who's thinking about investing in property, share this episode with them.
Definitely. And next time, we're diving into a really interesting topic, self-managing versus property management companies. It's going to be eye-opening for anyone considering how to handle their rental properties.
Yeah, I'm looking forward to that. Thanks for joining us today, everyone. Keep exploring those real estate opportunities.
And remember, building wealth takes time, but with the right strategies, you can absolutely get there.
Until next time, take care.